Imagine waking up to a single headline that wipes trillions of dollars off global markets before lunch, not because of a recession or a financial scandal, but because ships stop moving and chips stop flowing. And in that silence, the modern economy suddenly realizes how fragile it really is. That is the kind of shock a China-Taiwan semiconductor blockade would deliver. A shock large enough to trigger an estimated $12 trillion global market crash. Not in theory, but in the very real plumbing of how money, technology, and production move around the world today. To understand why this scenario is so explosive, you first have to understand what Taiwan actually represents in the global economy. Taiwan is not just another manufacturing hub, it is the heart of advanced semiconductor production. More than 60% of the world's foundry capacity is concentrated there, and when you look at the most advanced chips used in artificial intelligence, smartphones, data centers, military systems, and high-performance computing, one company dominates the picture. Taiwan Semiconductor Manufacturing Company, better known as TSMC, produces close to 90% of the world's most advanced logic chips at nodes that no other manufacturer can reliably match at scale. These chips are not interchangeable commodities. They are precision products built with extreme ultraviolet lithography, thousands of steps, and supply chains that take years to replicate. If access to these chips is disrupted, it is not like switching suppliers of steel or oil. Entire industries simply stall. Now imagine a scenario where China imposes a naval and air blockade around Taiwan, stopping the export of semiconductors without even firing a shot. The immediate impact would not be limited to Taiwan or China. Global equity markets would react within minutes. Technology stocks would be hit first and hardest. Companies like Apple, Nvidia, AMD, Qualcomm, and hundreds of others depend directly or indirectly on Taiwanese chips. Without them, production forecasts collapse. Earnings guidance gets pulled. Valuations based on future growth instantly become meaningless. Trillions of dollars in market capitalization could evaporate in days, not because demand disappears, but because supply becomes physically impossible. But the shock would not stop with technology. Semiconductors are the hidden nervous system of the modern economy. Cars today are rolling computers. A single electric vehicle can contain thousands of chips controlling everything from battery management to braking systems. During the smaller chip shortages of 2020 and 2021, global auto production fell by millions of vehicles, costing the industry hundreds of billions of dollars. A full Taiwan blockade would be that disruption multiplied several times over. Automakers would halt production, workers would be furloughed, supply chains stretching from Germany to Japan to the United States would seize. Stock prices in industrial and consumer discretionary sectors would follow tech stocks downward. Financial markets would then begin to price in second-order effects. Banks exposed to these industries would see rising credit risk. Export-driven economies would face sudden trade imbalances. Currencies of manufacturing-heavy nations could weaken sharply as investors flee to perceived safety. Global indices like the S&P 500, the Nasdaq, the Nikkei, and the Stoxx Europe 600 would all feel the pressure. When analysts talk about a $12 trillion crash, they are not suggesting a single-day event, but a cascading repricing across equities, bonds, and derivatives as uncertainty replaces confidence. History gives us smaller previews of how this plays out. During the 1973 oil embargo, energy supply disruptions triggered stagflation and a deep global recession. In 2008, the collapse of mortgage-backed securities revealed hidden dependencies inside the financial system, leading to a synchronized market crash. A Taiwan chip blockade would combine elements of both. Like oil, chips are a critical input for almost everything. Like 2008, the exposure is deeply embedded and poorly understood by most investors until it is too late. The difference is speed. In a hyper-connected digital market, information and panic travel instantly. Another factor often underestimated is the psychological impact. Markets do not only move on numbers, they move on narratives. A blockade would signal a permanent shift in the global order, raising fears of prolonged conflict between major powers. Investors would not just be pricing lost profits, but a world where globalization itself is reversing. Long-term capital investment decisions would be frozen, mergers would be delayed, startups dependent on advanced chips would struggle to survive, venture capital would dry up, the innovation engine that has driven growth for decades would sputter, governments would respond, but not fast enough to prevent damage. Strategic reserves of chips do not exist the way oil reserves do. Building new fabs in the United States or Europe takes years and costs tens of billions of dollars per facility. Even with unlimited funding, the expertise, tooling, and supplier ecosystem cannot be replicated overnight. Policy announcements might stabilize markets temporarily, but fundamentals would remain broken. This is why economists and defense analysts consistently describe Taiwan as a single point of failure in the global economy. Yet, even in this bleak scenario, markets are never uniform. Crashes are selective. Capital does not disappear, it moves. When investors lose confidence in paper assets tied to growth and stability, they look for places where value is preserved rather than promised. In past crises, this shift has been visible in commodities, currencies, and particularly in assets with no counterparty risk. Understanding which sector could defy a $12 trillion sell-off requires stepping back and asking a simple question. When the most advanced technology on Earth becomes unavailable, what do people trust instead? The answer begins to emerge when you look at how markets behave under extreme uncertainty and why certain assets have survived every geopolitical shock in recorded history, because